Good morning, ladies and gentlemen. Thank you so much for attending our webinar today, the UAE Corporate Tax. We are conducting this webinar in collaboration with the MBG group. We are pleased to have a group of expert speakers today, and my colleague, Mr. Mohammed Ali Farraj, the Assistant Business Development at MBG Group. He will take us to moderate this webinar. Good morning, Mr. Mohammed. How are you today?
Good morning, Mrs. Dua. How are you doing?
Fine, fine. Thank you.
Thank
you so much. Thank you. Thank you. You are most welcome. Mr. Mohammed, please, you can take the lead right now and manage the webinar. Our audiences, please, if you have any concern or questions, kindly drop your question in the section of Q&A. At the end of this webinar, Mr. Mohammed will take these questions and share it with our speakers. Then we will answer your concern further. Thank you so much.
Thank you, and thank you all once again for tuning into our webinar on corporate tax. My name is Mohammed Ali Farrag, and I am working with the Arabic Enterprise team of MBG Corporate Services. Let me briefly introduce MBG Corporate Services to you. So, as you see, MBG Corporate Services is a global consulting and advisory firm. We are headquartered in Singapore since 2002. We have now grown into 15 offices across 8 countries, covering Europe, Middle East, and Asia as well. We currently support over 5,000 clients globally, of which 100 are from the Fortune 500. So to help all the clients, we have a team of 600 members ready to serve. One of our key features in MBG is the foreign enterprise groups. We have several foreign enterprise groups, which are designed to bridge cultural, linguistic, and technical barriers as well. We have our European team that speaks French, German, and Italian, and Russian as well. We have our Arabic team, Chinese, Japanese, and Indian team. Having these different foreign enterprise groups, we have a diverse workforce consisting of different nationalities. As you can see, almost half of our workforce is based on the UAE. Being a full-fledged corporate services firm, we have a wide variety of in-house expertise. So with our wide range of services in MBG, MBG can support company at any stage of their life cycle. So even before entering the market itself, to company setup, to growth, maturity, or further extension, we can help you achieving your goals. To give you a better overview, we have 8 verticals of services. So starting with the audit, we are a certifying auditing firm and one of the first and few official certifying bodies for the National Infantry Value Certifications, better known as ICV. This was initially rolled out in Abu Dhabi under ADNOC, but has now become crucial on a federal level. Going to the risk, our specialized risk team covers everything from internal audit, forensic services, feasibility, and market studies, to name few. Going to the indirect tax, we also have our specialized indirect tax team with experts directly coming from the FTA. As a registered tax agents, we advise clients on VAT, excise, and customs as well. To the direct tax, we have also a large in-house direct tax team with experienced professionals advising on international tax, permanent establishment, transfer pricing, and course to corporate tax, where we are helping clients with their registrations, impact assessment, and several other services as well. We also support in merger and acquisition, legal advisory, including business setup and PRO, strategy and transformation, and technology advisory as well. So starting with our first topic today, which is the corporate tax, we do have Mr. Janardan Singh. He's a chief operating officer as a senior partner also in indirect tax. He has rich experience in consulting dealing with the matters pertaining to corporate tax, international tax, transfer pricing, expatriate tax, and due diligence as well. Mr. Janardan has worked on issues related to permanent establishment, source-based taxation of income such as royalty, fee for technical services, due diligence, and has significant experience in the area of inbound investment and cross-border advisory. So over to you, Mr. Janardan.
Thank you, Mohammed. and welcome to all of you for joining the today's webinar. So it is a very hot topic nowadays in UAE corporate tax, as it is now live. Since its introduction last year or announcement last year, and as it is effective from 1st June 2023, various developments have taken place in the form of either public consultation document or then coming of the federal decree law, and now a line or row of cabinet or ministerial decision over the same. So before we jump into the technical aspects of the UAE corporate tax, I would like to bring to your attention the macro overview of bringing this concept or the UAE corporate tax. Next slide. So there are few things which needs to be highlighted before we go further and we go into the technical aspects. When government introduced this law, they have kept it very simple and they have followed the internationally accepted policies and practices. Instead of bringing any new concept which will be difficult for the companies and the corporates and the business entities to follow, they have kept it simple so that everyone can comply with it, to do a minimum compliances and focus on their main businesses. So this results in ease of compliance, transparency, and predictability. And this corporate law is also conducive to businesses. Why it is conducive? Because they have taken care the finer aspects of each type of businesses. Their individual needs have been catered. Maybe it is small and medium businesses, free zones, multinationals. For everyone, government has incorporated the provisions which are convenient for them, and this will boost the confidence of the investors in UAE, because earlier UAE was known for its tax-free regime. Only indirect tax was there, but now due to the introduction of the corporate tax, and now it is in line with the global practices which are there worldwide. But even then they have kept their competitiveness, and as compared to the other regions in the Middle East, they are still at a lower tax rate. So it will make UAE still a attractive jurisdiction to invest. Next slide. So whenever we discuss about a corporate tax, so first thing comes into the mind that who will be the taxable person. So once we want to know the taxable person, then worldwide there is a concept of residency. So in UAE as well, they have introduced two type of residential status. One is the resident persons and another is the non-resident person. Who all are considered as a resident person? So previous slide, please. So who all are considered as a resident person? Juridical persons who are incorporated in UAE, includes free zone persons, as well as those juridical persons who have been incorporated outside UAE but are effectively managed and controlled in, means their management is in UAE and they are controlled from UAE. Then in that case they will also be considered as a resident for corporate tax purposes in UAE. And in case of natural person, any natural person whosoever is conducting any business or business activity in UAE will be considered as a resident person. So once the residential status will be considered as a resident person, so the scope of income which will be offered to tax in their hand will be determined the basis the same. So in juridical person case, worldwide income will be taxable in UAE, subject to certain exemptions which are there in the law itself. And in case of natural person, their income from business and business activities will be taxed in UAE, whether it is earned in UAE or outside from the businesses conducted in UAE. Next slide. So in case of non-resident, so there are three types of persons who can be considered as a non-resident persons for the corporate tax. permanent establishment of foreign entities in UAE, and the foreign entities who are having any state source. When we say state, means UAE, state source income. And there is a third concept which is known as nexus in the UAE, that is income from the any immovable property in the UAE. So in this case, the scope of income which will covered in case of non-resident person is in case of permanent establishment, any income which will be attributable to the P in UAE will be taxed in UAE as per the corporate tax law. And for the state sourced income, income having source in UAE will only be taxable. Other incomes will not be covered in case of foreign entities or non-resident. And in case of nexus, again, a concept of attribution, and the income which will be attributable to the nexus in UAE shall be taxed as per the corporate tax law. Next slide. So worldwide, a concept is there in case of corporate tax, which is known as permanent establishment. So multinational enterprises many times face issues related to permanent establishment because sometimes it results into double taxation, once in a resident state and once in a source state. So in UAE corporate tax as well, there is a concept of permanent establishment for foreign enterprises. And there are basically four type of permanent establishment. One is fixed place P, second is dependent agent P, third is installation P, and fourth is in the form of personal presence, means individuals presence in UAE. So when it comes to fixed place P, so in case there is any fixed place or establishment in UAE of a foreign enterprise from where business is conducted, then it will be considered as a fixed place P. So example of the same is the place of management, any branch office, license office, project office, factory, workshop, etc. And in case of agency P, there are two type of division which we can make in case of agency P. One is independent agent and second is dependent. So independent agent are those persons who are or entities who are doing business in their ordinary course of business, and they are not economically or legally dependent on the foreign enterprise, and they are not also exclusively working for the same. But in case of dependent agent, it has been seen that they are working on behalf of the foreign enterprise. They are economically and legally dependent, or we can say not independent from the foreign enterprise. And they many times it has been seen that they are exclusively working for the foreign companies. So in that case, they will be considered as a dependent agent. So in order to determine agency P and dependent agent, a person must be conducting business or have authority to conduct business of foreign company or non-resident in UAE. So when we say authority to conduct business, then in that case, we have to further see that what type of business they are conducting. So as it is a very fact-based exercise and very subjective, so further we have to see whether that agent or dependent agent is concluding any contract on behalf of the foreign enterprise, or they are doing any negotiation and which is endorsed by the foreign enterprise without any material change. So in that case, dependent agent P is determined, and once the dependent agent P is determined, attribution of profit, global profit of the foreign enterprise will take place in UAE, and that will be taxable in UAE. Even though in this case, a person has to analyze the tax treaty or double tax avoidance agreements between the UAE and that respective jurisdiction. And in case there are any beneficial provisions, and in case there are any provisions which narrow down the scope of P, then in that case that benefit can also be availed by the entity, and they can come out of P. But this is something which is very carefully needs to be analyzed, and because taxpayers every time shows that they are doing independently business, and they are not economically and legally dependent upon the foreign enterprise. But tax authorities every time ask that you have to show with the supportive documents that and in substance you are really doing such type of activities independently or not. Then comes the installation P, and in UAE they have covered in case of installation only exploration and exploitation of natural resources, and the formation of P due to personal presence in UAE. So mere sometimes it seems that mere presence of any individual in UAE may results in a P of a foreign enterprise, but it is not the case. There are few conditions which have been mentioned that that individual must carry out the activities which are the core income generating activity of the non-resident person, and that non-resident person is deriving any UAE sourced income. If these conditions are not satisfied, in that case, even though a person is temporarily present in UAE and working for their parent company or for their employer, or we can say foreign enterprise, it will not be considered as a P, and they can come out of the P. But P is something which requires proper documentation, and every time whenever any question or query are raised by the tax authorities, every company has to substantiate their position with proper supporting documents in the form of agreements, in the form of email communications, in the form of other documents such as invoices or business communication with the customer and client. Next slide. Now we can analyze the UAE sourced income. What type of income will be considered as a UAE sourced? So any income which will be derived from any resident person in UAE will be considered as a UAE sourced income. And in some cases, any income which is derived from non-resident but attributable to the permanent establishment of that non-resident in UAE shall also be considered as a UAE source income. Apart from this, any income which will be derived from any activities which are performed in UAE, assets located in UAE, capital invested, rights of use and services performed or beneficial or benefited from the UAE shall also be considered as a UAE source income. So there are few examples where we can say that these type of income will be considered as a UAE or state source income. Those are sales of goods in UAE or any provision of service in UAE will be considered as a source income. And the contracts either performed wholly or partially in UAE shall also be considered as a state source income. And any type of income derived from a movable property or immovable property situated in UAE can be considered as a UAE sourced income. And apart from this, sometimes some incomes can be generated from the intellectual property rights, intangible assets or properties, and that income shall also be considered as a UAE sourced income. So at the time of determining whether an income is UAE sourced income or not, the fundamental thing is any nexus with the UAE needs to be there, whether it is coming out from a resident person, non-resident person having presence in UAE, or from any assets or any activities which are carried out in UAE. Next. So whenever any transactions takes place between two parties across the border, then there comes in role the double tax avoidance agreements. So UAE has also entered into with tax treaties, or you can say DTAs with various countries. And why these are very important in now after introduction of the corporate tax is because now companies can get benefit out of that, because earlier there was no tax in UAE, so there was no requirement of analyzing such tax treaties or DTAs. But now, as we can understand that DTAs provisions, if they are beneficial to any party or any entity, then they can take benefit from that, and it will overrule the provisions of the decree law in UAE. So first thing is what DTA do is the allocation of taxing right between the two jurisdictions, means UAE and the other country, that particular revenue will be taxed in which country, whether in resident state or in source country. It also helps in avoiding double taxation between two countries, because as per the provisions of tax laws of two jurisdictions, there is possibility that a particular income is taxable in two different jurisdictions. But if there is a DTA between these two jurisdictions, then entities or the companies can always go for the same and can get the beneficial provisions done, and can avoid the double taxation situation. So sometimes it happens that if a transaction takes place between two jurisdictions, tax is deducted by one jurisdiction and the taxability arises in another jurisdiction. So in that case, if there are provisions in the DTA between these two jurisdictions, then foreign tax credit can also be availed. Apart from this, as we can understand that wherever there is a tax, there is possibility of litigation, and for those litigations, dispute resolution mechanisms are very important. And if there is no dispute resolution mechanism, then investors, or especially the foreign investors, will not be very confident in investing in any other foreign jurisdiction. So dispute resolution mechanism is also provided into the DTAs, which are entered by the UAE with the other jurisdictions. So companies can go for the same in case of any dispute. It also prevents from the discrimination among the taxpayers. So generally what happens whenever any tax law is framed, so there are some provisions which are light on the part of the locals, or you can say the residents, but for the foreign entities or foreign individuals, the laws are, you can say, more stricter. But whenever there is a DTA concept, then there is a clause of non-discrimination, and taking benefit of those clause, any situation of discrimination can be prevented and avoided. And whenever a transaction takes place between two jurisdictions, and resident source is different and the source state is different, there's this possibility that taxpayer may avoid taxation in both the jurisdictions. So in that case, to avoid such type of situation, or to avoid the situation of base erosion and profit shifting, there is a concept of exchange of information between two contracting parties, two contracting states. So wherever they require any such information, they can ask from the other contracting state. And if any things come out that there is a possibility or scope of any avoidance of tax, that can be avoided and that can be collected. Next. So on this slide, we have identified the 4 situations where business models can be very risky and needs proper analysis. And prior to entering into any such type of business model, since now in UAE corporate tax is live, so everyone has to consider each and every aspects before entering into any such type of business model. So it is a very general or common practice that foreign companies form a license office, representative office, or temporary offices in particular state, in our case UAE, to execute any contract which is awarded to them, or to carry out any type of activity in particular state. But now, since the UAE corporate tax is there, and there is a concept of permanent establishment. So there is a risk of permanent establishment, and PE exposure can only be avoided if these type of entities are formed and with a proper documentation, with all their arrangements, with all their agreements, all their mm, uh, activities should be of such type which are not which not attracts PE exposure for such enterprises. That's aspects needs to be taken care. As we have discussed earlier, that there is a concept of dependent agent and independent agent. So in order to avoid dependent agent P, a company at the time of entering into a contract with any type of agent to execute any business has to consider all those aspects which can form that particular agent a dependent agent, and expose that foreign company in the form of a PE exposure in UAE. And once the PE is established in the form of dependent agent, then comes into the picture the attribution of profit. And any attribution of profit takes place on the basis of the documents and on the basis of the substance instead of the form. So at that point of time, there is a possibility that global profit is attributed and taxed in UAE, and the possibility of double taxation may arise. So in order to avoid such situation, robust documentation and proper arrangements needs to be entered, and such type of situations can be avoided by taking into consideration few points which may not be considered earlier, but now since UAE corporate tax is there, so everyone has to consider all those aspects. Third is, previous slide. Third is the concept of EPC contracts. So in EPC contracts, as we can understand that there are various things which needs to be taken care, because in EPC contracts generally there are onshore supplies, offshore supplies, onshore services, offshore services, and there is all again the division of activities, and sometimes in order to avoid taxation, activities are divided in such a manner, or contracts are fragmented in such a manner so as to shift profit to the lower jurisdiction. So in this case also, now it will be very much required to frame the contracts to, and it should be in line with the considering the UAE corporate tax and the particular direct tax of the resident jurisdiction, so that PE situations can be avoided. Fourth, but last but not the least, is the employee deputation. So as we have earlier seen that there is a concept of P in the form of presence of personnel. So whenever a foreign company send their employees on deputation to their subsidiaries or any other group or related entities in UAE, then in that case, there should be proper contract between the two companies and with the employees. And apart from all such type of documentation, now we have to be very careful that what type of activities these employees are carrying out in UAE. Because if those employees are doing any activity which is in the form of doing business, or they are participating in concluding contracts related to business, or they are doing any activity related to negotiation of contracts, all such type of things will create the P of the foreign entity in the form of that personnel in UAE. So that's why these four situations are needs to be taken care in such a manner so as to avoid the P aspects and to avoid the double taxation in the form of taxation in UAE. Next slide. So now comes the tax grouping concept. So earlier also in UAE, in VAT, they have introduced the tax grouping. But now in corporate tax, this is something which is very, you can say on various aspects, it is different from the tax grouping, which is already there in the form of VAT. So there are few conditions which needs to be fulfilled or satisfied before entering into a tax group. So first of all, we have to understand what is tax group. So in case of a tax group, what if you have various entities, means related parties or group entities in UAE, you can club all these entities as a single taxable person in the eyes of the corporate tax, and only one compliance needs to be done. So what is the benefit of doing all such type of things? Because in this case, they can set off the losses of the group entities with the group entities who have profits, and only on the net profit of the group needs to corporate tax needs to be paid, and compliances will also be reduced because now only one taxable person has to be considered, and a single taxable person's compliances needs to be done. So what are the conditions to form a tax group in UAE corporate tax? First is the presence of the parent and subsidiary relationship. So there must be a parent and subsidiary relationship, and the parent and subsidiary both must be resident juridical person in UAE. And there is a requirement of 95% of shareholding, voting rights, and right to profits condition. If any one of these condition is not satisfied, then in that case, those entities cannot form a tax group in UAE. Apart from this, none of the group member should be an exempt person or a qualifying free zone person. Means, in other words, we can say any entity whose income is exempt cannot be a part of a tax group. So at the time of analyzing all such type of things, whether we have to form a tax group or we can form a tax group and what is the benefit, we have to consider that these group entities are fulfilling all such conditions or not. Last but not the least is that all the entities who are willing to form a tax group must follow the same financial year and the accounting standards for financial year. There. So in this case, few things needs to be considered, that once a tax group is formed, then in that case, the liability, corporate tax liability of each member is joint and several. And the primary responsibility of doing the compliances is of the parent. So yes, but in the UAE corporate tax law, they have given the flexibility for entities to enter into the group or leave the group as per their wish, and after fulfilling few conditions. And one more thing which is very important, that intra-group transaction between these related parties or the entities which are forming tax group shall be eliminated for the purpose of corporate tax. So these are the few benefits of forming the tax group. But yeah, every time whenever any company or group move forward to form a tax group, they have to do proper analysis, and sometimes restructuring also required. But those restructuring should be done in such a manner that there should be any commercial aspect behind the same. Otherwise, there is a provision related to general anti-avoidance rules, and any type of restructuring which is done for the purpose of obtaining corporate tax benefit only, and there is no other commercial substance behind the same, will not be allowed, and companies may uh, face some type of penalties and the tax exposure in such a case. Next slide. Now comes the concept of the transfer pricing. So for transfer pricing, why this concept is very important? Because in case of related party globally, it has been seen that the problem of base erosion and profit shifting is there, because as a group, they want to maximize their profit. So for that, generally what group entities do, they want to shift their profit, or they want to shift their base to some low jurisdictions, low tax jurisdictions or nil tax jurisdictions. So in order to avoid such type of things, there is a globally, there is a concept of transfer pricing. And in transfer pricing, what companies has to do, they have to analyze the transaction and determine the value of the transaction on arm's length principle, so as to avoid any type of adjustment or any type of shifting of profit from one jurisdiction to another jurisdiction. So for this, they have to done the benchmarking analysis, because when we say the arm's length price analysis, then in that case, arm's length price is a price at which any entity would have entered into a transaction with an unrelated. So this type of analysis needs to be done so as to prove that the value at which any transaction has been entered between the enterprises, related parties are at the arm's length. So in UAE corporate tax, they have introduced international as well as domestic transfer pricing concept. So it is more important in case of UAE. So every transaction should be done in such a manner so that any future adjustment or adjustment on part of transfer pricing can be avoided. Next slide. So in transfer pricing, we have to analyze these three concepts: related parties, who all will be considered as a related party for the purpose of transfer pricing. So if any person is covered under the definition of related party, then only that transaction needs to be at the arm's length, and all type of compliances and all type of documentation work has to be carried out. Apart from this, there is a concept of control. So there is a percentage of broadly 50% when any control is to be determined for the purpose of the transfer pricing. And in the UAE, they have also introduced in the law connected person concept. So why there is a concept of connected persons? Because there is a possibility of shifting of income in the hands of the individuals, because right now they have not introduced any type of tax on the individual income if it is not in the nature of business or business activity. So connected persons covers the individuals having ownership interest who can influence the transaction, and directors or officers, and in case of unincorporated partnership, any partner. And there are few other provisions which needs to be analyzed, and then connected persons can be determined. And if there is any transaction between the related parties or connected persons, proper benchmarking analysis needs to be done so that to show that each and every transaction is at. Next slide. So for the arm's length price or benchmarking analysis, what are the appropriate timelines before the law is effective? So now in the law itself, they have mentioned the transitional rules. As per the transitional rules, opening balance of the tax period, first tax period, should be the closing balance of the period prior to that first tax period. So in that case, the balances or closing balances of the financial year, which is prior to the first tax period, should also be on the basis of arm's length principle. So that's why even if the financial year starts, first financial year of a particular company starts for the purpose of the corporate tax from 1st January 2024. In their case, the books of accounts of 31st December 2023 also needs to be reinstated on the basis of the arm's length principle. During the tax period, so during the tax period, any type of transaction which is covered for the transfer pricing provisions, and arm's length price needs needs to be determined so that in future no adjustment on the part of transfer pricing has to be done. And post-tax period compliances, what happens that uh, when the financials are prepared and the financials results of the comparables would be updated. So at that time only a person after doing the benchmarking analysis comes to know that their transactions are at arm's length when it is compared with the comparable companies in the industry or not. So at the time of doing transaction itself, they have to be very cautious while doing all such type of transactions, because the documents or the details or the figures of other comparable companies will be available only after the tax periods compliances will be done. Next. Now comes the concept of the free zone persons. So as we all know that free zones play a very vital role in UAE's economy. And if a person is in free zone, so they are enjoying various type of exemptions and benefits prior to the corporate tax. And in the UAE corporate tax as well, they have continued with the exemptions. And first of all, they have defined the free zone person. So any juridical person who is incorporated in free zone is known as is considered as a free zone person, and any non-resident persons whose branch is registered in free zone will also be considered as a free zone person. So once we determine that this person is a free zone person, then we have to check with the conditions whether that free zone person is a qualifying free zone person or not a qualifying free zone person. So there are few conditions which needs to be satisfied. First is the maintenance of adequate substance in free zone. Second is deriving qualifying income, and qualifying income is defined in the cabinet decision number 55. So in that they have come up with the provisions that in which case income will be considered as a qualifying income. Third is there is an option for the free zone person to opt that they will not enjoy any benefit of corporate tax exemption. So they if they have not elected for such type of option, then only they can be considered as a qualifying free zone person. And fourth is that a qualifying free zone person has to comply with the transfer pricing rules and documentation, and they have to maintain audited financial statements as per IFRS. So in case a person or a free zone person needs to be qualified as a qualifying free zone person, then in that case they have to maintain financial statements and they have to get it audited, and that should also be in line with the IFRS provisions. Apart from this, as government understands that even though a free zone person is carrying out qualifying activities, but there is a possibility that they are doing some income or they have some non-qualifying revenues as well. For that, they have come up with the de minimis requirement. And as per the de minimis requirement, 5% of the total revenue of free zone person or 85 million, whichever is lower, is allowed as a non-qualifying revenue. So if any free zone person is covered or is satisfying this condition of de minimis requirement, then entire income of that free zone person will be exempt. Otherwise, in case this requirement is not met, then in that case, for that particular tax period and for subsequent 4 tax periods, this exemption of qualifying free zone person will not be available to that free zone person. Next. So as per the ministerial decision, now they have come up with the definition of qualifying activities and excluded activities. So there is a list of activities which are considered as a qualifying activities, and there are another list which is considered as the excluded activities. Means whenever such type of activities, means excluded activities will be carried out, that will not be considered as a qualifying activity, or you can say that that will be a non-qualifying activities, and that in that case qualifying income will not be condition of qualifying income will not be satisfied. Next. So these are the list of designated zones in UAE for VAT purposes. So there are 7 Emirates, and as in these Emirates, these are the list of designated zones. So yeah, most of the designated zones are in Dubai, and there is only one designated zone in Azma. Next. So once a free zone person is determined as a qualifying free zone person, then comes into picture the what will be the taxability of that particular qualifying free zone person. So in case qualifying free zone person determines any income which is not a qualified, in case a free zone person is not a qualified free zone person, then normal tax rate will be applicable, that is up to AED 375,000 no tax, and above that there will be a tax exposure of 9% on such type of free zone person. But if a person satisfies the condition of qualifying free zone person and derives any income from any other free zone person, in that case income other than excluded activity, the list which we have seen in earlier slide, any income from any activity which is other than excluded activity, it will be considered as a qualifying income and will be required to be or offered to tax at the 0%. But in case a qualifying free zone person derives income from non-free zone person, that is in mainland or outside UAE, and the activities are qualifying activities which is not excluded activity, then again it will be considered as a qualifying income and will be taxable at the rate of 0%. In case any person does not fall under first two conditions, and any qualifying free zone person has any other income apart from first two conditions, and in that case income is from excluded activity or income is from activities that is not a qualifying activities, then the requirement or the provisions of the de minimis clause needs to be checked, and if it is satisfied, then in that case it will be considered as a qualifying income and taxability will be at the 0%. And in case it is not satisfied, de minimis clause is not satisfied, all income will be taxable at the rate of 9%. And for the subsequent 4 years as well, there will be no such exemption available to that qualifying free zone person. Apart from this, if a qualifying free zone person has any income from domestic P, when we say domestic P means any P which is within the UAE, and foreign P means any P which is in outside UAE, and that person has any income from any such type of P, that will be required to be taxed at the rate of 9% without any threshold benefit. Next slide. So we can understand the de minimis clause with these two examples. In first example, we have qualifying revenue of 125 million dirham and non-qualifying revenue of 5 million dirham. So total revenue in this case is 130 million dirham. And the 5% of total revenue is 6.5 million dirham. And there is a threshold amount which is mentioned in the de minimis clause of 5 million dirham. And out of 6.5 million and 5 million dirham, lower is 5 million. So as the de minimis amount, which is 5 million in this case, is equal to non-qualifying revenue, so the de minimis clause is satisfied, and all income means total revenue of 130 million dirham will be a qualifying income and tax at the 0%. But in second example, we can say that qualifying revenue is 65 million dirham Non-qualifying revenue is 5 million dirham and total revenue is 70 million dirham. In this case, 5% of total revenue is 3.5 million dirham. And the threshold amount or the fixed amount is 5 million dirham, and lower of these two amount is only 3.5 million dirham. So in this case, as the de minimis amount is 3.5 million dirham and the non-qualifying revenue, which is 5 million dirham, exceeds the de minimis amount. So it has not satisfied the de minimis clause, and the entire revenue, means total revenue of 70 million dirham, will be required to be taxed at the rate of 9%. Next slide. So in this slide, we can understand the taxability of income from immovable property in free zone. So in case there is any property, immovable property in free zone, so we have to divide it into two parts, whether this property is a commercial property or a non-commercial property. In case of non-commercial property, whether any income is generated from a free zone person or a non-free zone person, both will be considered as a non-qualifying income and will be taxed at the rate of 9%. But in case of commercial property, if it is generating any income from free zone person, that will be considered as a qualifying income and taxed at 0%. But if commercial property located in free zone is deriving any income from a non-free zone person, then it will not be considered as a qualifying income and will be offered to tax at the rate of 9%. So in this slide, we can understand that only the case where the qualifying free zone person having immovable property situated in free zone, which is considered as a commercial property and is deriving income from free zone person, only this condition will be will satisfy the concept or of qualifying income and will be taxed at 0%, and rest other cases will be taxed at the 9% flat. Next slide. So now we have covered on this in relation to free zone person various miscellaneous concepts. So there is a concept of small business relief in which if any company or any taxable person, you can say whether it is a juridical person or a natural person, having income of or revenue of 83 million, then they can enjoy the benefit of small business relief and they will not be liable to tax, means corporate tax. But in case of qualifying free zone person, this benefit is not applicable. So when it comes to the audited financial statements, as we discussed earlier, it is mandatory to enjoy the benefit of qualifying free zone person, and they have to get their audited their audit done as per the as per the IFRS provisions. Apart from this, there is a transfer pricing documentation requirement. So there are two situations. One is if the free zone entity is a constituent entity of multinational enterprise group and their consolidated group revenue is 3.15 billion AED. In that case, transfer pricing documentation requirement will be there. And other tax, in case of other taxable person, in case they have a revenue of 200 million AED, in that case, they are required to do transfer pricing documentation. So transfer pricing documentation in form of local file and master file is to be maintained, where the revenue equals or exceeds the monetary threshold limits, which we have discussed in the corporate tax law. And regardless all these things, transactions with the related parties and connected persons are required to be benchmarked at the LP and needs to be disclosed in the transfer pricing compliances. So these threshold limits are only for the maintenance of transfer pricing documentation, and disclosure of transfer pricing needs to be done whenever there is any transaction with the related party or with the connected. Next slide. So compliance requirements. So in case of free zone person, or you can say qualifying free zone person, they have to obtain the tax registration number. No monetary threshold is there. They have to prepare their tax computation sheet. They have to file the corporate tax return, even if their income is exempt. And for the transfer pricing compliance requirements, they have to comply with the arm's length norms with no monetary threshold, and they have to file the transfer pricing disclosure form without any monetary limit, even if they have a single transaction with the related party or the connected person. So as we know that there are various concessions which are enjoyed by the free zone persons. So in corporate tax as well, they have mentioned that for the remaining period of tax, for the remaining period of concession as per their specific legislation which governs the free zone, tax concessions will be available, and this can be extended by the government, or but the maximum extension of tax concession can be given not for more than 50 years. Any foreign judicial persons managed from free zone person will not enjoy the benefit of free zone incentives because they are not incorporated in free zone. So that's why the foreign judicial persons managed from free zone will not get any such type of benefit. Next slide. So there are few concepts which needs to be understand whenever we are dealing with any free zone person. So accounting standards. So they have mentioned in the law that accounting standards which are accepted in UAE are required to be followed for the preparation of financial statements and books of accounts, and most frequently accounting standards which are used in UAE are IFRS. So these international financial reporting standards needs to be followed at the time of preparation of books of accounts and the financial statements. Method of accounting which is suggested is the accrual method of accounting, and a separate ministerial decision is expected for the maintenance of books of accounts under the cash system of accounting. Any transaction which is done in the form of international transaction needs to be converted at the rate of foreign exchange, which is suggested or recorded by the UAE Central Bank. So exchange rates which are suggested by the UAE Central Bank has to be used for conversion of the foreign exchange transactions in the books of accounts. So there are few transactional provisions. As per the transactional provisions, books of accounts needs to be prepared in such a manner so that the it follows the arm's length principle, and the closing balances of the tax of the financial year prior to the first tax period has to be done in a way so that it can be used as an opening balance for the first tax period. So these things has to be considered in mind while preparing the financial year financial statements of a tax of a financial year prior to the first tax period. Next slide. So corporate tax rates, there are two types of corporate tax rates. One is for the taxable persons other than qualifying free zone person, means normal taxable person. So in that case, a threshold limit of 375,000 dirham is allowed, up to which tax rate will be at the rate of 0%, and beyond which there will be a taxability of 9%. And for the qualifying free zone person, also there is a 0% or 9% tax rate, but in that case, if the income is qualifying income, tax rate will be 0. But in case income is non-qualifying income, or it will not satisfy the de minimis clause, it will be taxed at the rate of 9%. Next slide. So UAE is a member of OECD BEPS Inclusive Framework, and it is committed to follow the BEPS Pillar 2 provisions. So as per the BEPS Pillar 2 provisions, there is a concept of global minimum tax. And as per that concept, since in all over the world, there are various tax jurisdictions which are imposing either nil tax rate or very low tax rate. So globally, a consensus has been formed that effective tax rate for any entity, or you can say for the multinational enterprise, should be 15% at least, so as to avoid the situation of base erosion and profit shifting. So yeah, UAE is also committed, but they have not yet adopted the this BEPS Pillar 2 provisions. And whenever the concept of global minimum tax will be adopted, then in that case, uh, even the entities, MNE groups which are present in UAE, they have to pay effective tax rate of 15%. So we have to wait and watch unless and until those provisions are adopted, the taxability will be at the normal rate of 0 and 1%. Next slide. So on this slide, we can discuss that how any taxable person can compute their taxable income. So the net profit which will be taken as a base will be the profit as per the standalone financial statement which will be prepared following the standards which are IFRS. And from that there are few adjustments which needs to be done. So there is a list of expenses which needs to be disallowed, and when we say disallowed means those expenses will be added back to the net profit as per the financial statements. And corporate tax will be calculated on the higher profit as compared to the net profit. So there is a list of expenses which are disallowed. First is unrealized loss and net interest expenses beyond 30% of EBITDA. EBITDA is earning before interest, tax, depreciation and amortization, and 50% of total entertainment expenses. So whatever entertainment expenses have been incurred by a company, flat 50% will be added back to the net profit as per the financial statements. So while classifying any expense as entertainment expenses in the books of accounts, company or the taxable person has to be very mindful that they should not enter or book any expenses which are not in reality entertainment expenses in the head entertainment expenditure. And at the time of incurring such expenditure also they have to be very mindful, because 50% amount is a very big amount and it may results in more profitability and more tax on such profits. Donation, grants, or gifts made to non-qualifying public benefit entities will also not be allowed and will be added back. Any fines, penalties, and any recoverable VAT which can be recovered is also added back to the profit for the purpose of corporate tax. So any personal and capital expenditure which are booked in the books of accounts has to be added back. Any distribution of profit in the form of dividend has to be added back. Expenses which are not linked to a taxable person's business. So up till now, even if you are booking any expenses which are not related to your business, no one is there to ask any question because it is not going to impact anyone. But now, as on the basis of that net profit, um, corporate tax has to be computed. So in that case, any expenses which is not related to the business will not be allowed. Any bribes or other illicit payments will also be added back, and corporate tax liability which will be paid also added in this case. Exempt income, so dividend income from a participating interest and income of a foreign P will be also not taxed and will be reduced from the net profit. So, and last but not the least is the unrealized gain incentives or reliefs. So these are few adjustments which needs to be done for computation of taxable. Next. So here it is very simple that once the net taxable income, as mentioned in the earlier slide, is determined, in that case up to 375,000 dirham, there will be zero tax. Beyond that, there will be tax at the rate of 9%. Then total corporate tax liability will be determined, and from the total corporate tax liability, withholding tax credit will be reduced. Any foreign tax credit, if any taxes are paid in outside UAE jurisdiction, that will also be reduced. And there are few credits and other reliefs which may be allowed, that will be reduced to come to the net corporate tax liability. Next slide. So in form of transfer pricing documentation, there are three types of three-tier documentation. One is TP disclosure form, one is country by country reporting, and local file and master file. So for documentation of local file and master file, below are the threshold which are mentioned, which we have earlier discussed. So these are the threshold. In case these threshold are met, then these documents are required to be maintained. Next slide. So we can divide the compliance requirements in 6 parts. Registration. So every entity which is liable to
Mr. Janardan, if you don't mind, we are running out of the time and we still have 4 speakers. We need to give them the chance to start speak. If you don't mind, can we end your presentation right now? Thank you so much, Mr. Mohammed. Can you take the lead and introduce the second speaker, please? Mr.
The
Mohammed?
presentation is just getting over. So yeah, this is the last slide.
I'm so sorry. I'm so sorry, but we are running out of the time right now. We are exceeding the limit. It should be 1 hour only.
1 minute. I can complete in 1 minute. So there is requirement of registration, tax payment and filing within 9 months period. Tax has to be computed and corporate tax return needs to be filed. And there is a requirement of record keeping for 7 years. And if there is any clarification which is required, that can be obtained from the Federal Tax Authority. And assessment needs to be done on the basis of tax procedure law. And in case the business ceases, in that case, the registration which is obtained for the corporate tax purpose can be surrendered. Next slide. So this is the last that tax procedure laws are the law, which is also a federal tax law. And in this, all type of procedural aspects has been covered. So when we analyze the federal decree law, which is a corporate tax law, we have to also follow the tax procedures law, which determines the procedures which one has to follow. Apart from this, the government has come up with the explanatory guide, and this explanatory guides has detailed upon each and every provision of the corporate tax law. And along with that, we can read the corporate cabinet decisions, ministerial decisions, and FTA clarifications. So whenever we do any type of analysis, we have to done those analysis considering all these things in mind. Thank you for your patient hearing, and over to you, Mohammed.
Thank you so much, Mr. Janardan, for the great presentation. And just moving forward to our next topic, I would like to introduce Mr. Piyush Pandey. I would like to welcome Mr. Piyush Pandey. He's our senior partner in the Legal Services Department. So please, Mr. Piyush, over to you now.
So good afternoon, ladies and gentlemen. So now the long wait for the corporate tax is over now, and it has come into force from 1st of June 2023. So the basic question comes to everyone's mind that what kind of precautionary measure we need to consider and adopt so as to avoid any sort of hassle and stay compliant in the new corporate tax regime. So from our past experience in other jurisdictions where the similar provisions of the corporate tax has been introduced and implemented, we have noticed that the companies put their main focus on the compliances and proper documentation of their business transactions. So today I'm covering these two aspects, and it has helped the companies to avoid any dispute with the federal tax authorities, rather not only federal tax authorities, but with any other statutory authorities. So to start with the importance and benefit of the corporate sectoral compliances, how it is going to protect the companies in the new corporate tax regime. So first we need to understand what do we mean by the corporate sectoral compliances. So the corporate secretarial compliances, it is a mandatory regulatory function. The functioning of the company, it is being regulated by the set of process, set of procedure that is prescribed under the commercial companies regulations. So those set of process and procedures, it is called the corporate secretarial compliances. And it helps the companies to ensure effective communication among the shareholders as well as the board of directors. It helps in proper record keeping system in the system. It helps in establishing an effective corporate governance system in the company. So next question arises, why it is required? What are the benefits? So the first benefit, there are three fundamental benefits. And the first one for the free zone companies, it helps the free zone companies to avail the incentive of 0% corporate tax rate. And second, it helps the companies to prove the economic substance. And third, of course, it helps the companies to stay compliant and to protect the company against the consequences of non-compliance, which is the monetary penalties. Next slide. So it is very important how it is going to help the free zone companies to avail 0% tax incentive. We have seen the corporate tax law, it doesn't per se exempt the free zone companies from the purview of the corporate income tax. Rather, it has made them eligible to avail the 0% tax incentive. Of course, that is subject to certain conditions. And one of the condition is that the free zone company need to maintain the economic substance in the UAE. The corporate tax law doesn't define the test criteria, test parameters to meet or to demonstrate the economic substance. So the inference can be drawn from the economic substance regulations. The ESR, it lays down the three test criteria to demonstrate the economic substance. First is the company need to generate the income from the core income generating activities. Second, the company, the activity is being managed and directed in the UAE. And third one, the company should have adequate infrastructure in the form of number of employees, plant and machinery, office expense, etc. The test parameter number 1 and 2, it can easily be verified from your financial statement or by making the fiscal verification. The condition number 2, this can be only substantiated with the help of proper corporate secretarial documents. Next slide. Now, when it will be presumed that the activity is being considered as directed and managed in the UAE. So again, they have laid down further test parameters which need to be applied. The first one, the board of directors of the company, they are supposed to meet at adequate frequency. Adequate frequency, it is not defined, but as per the global corporate governance standard, it is usually once in every quarter. And the second one, the quorum for the board of directors meeting, they need to be physically present. This is very important. They need to be physically present in the UAE. And all the proceedings of the board of directors meeting, that need to be properly recorded in the form of resolutions in the minutes book. And this need to be duly signed by the directors and kept in the UAE. So these are the test criteria to prove the economic substance. Now, what are the consequences? The consequences under the corporate tax law, as I have explained earlier, that it helps the free zone companies to avail the 0% tax rate. So in case if the free zone company fails to prove the economic substance, then it will lose the opportunity to avail the 0% corporate tax rate incentive, and the profit will be taxed at the normal rate of 9%. Second consequences under the ESR regulations, the company shall be charged administrative penalty of 50,000 AED per financial year. And in case of subsequent non-compliances, in the next year, if the company again fails to meet the economic substance, then it will be extended to 400,000. Next slide. Now, apart from the corporate sectoral compliances for the economic substance, what are the other corporate sectoral compliances which each and every company need to follow? That is as part of good corporate governance practice and as prescribed under the commercial companies regulations. Of course, each and every company must have the board meeting in every quarter that I have explained. And apart from the board meeting, each and every company, they are supposed to have annual general meeting once in every year. And this need to be convened and held within 6 months from the close of the fiscal year. The 6 months period is for some free zone companies, and in the mainland, it is the 4 months from the close of the fiscal year. And in the annual general meeting, there are certain agenda items, certain business decisions that can only be transacted in the annual general meeting, which is approval of the financial statement, appointment of the auditors, appointment of the directors, and declaration of the dividend. Apart from that, the company is supposed to maintain certain statutory registers. For example, register of its members, register of shareholders, register of directors, managers, and register of contract with related parties. So these are the statutory registers that need to be maintained and updated at all point of time. Non-maintenance will attract the monetary penalties. And every company need to file the financial statement with the licensing authorities. So these are the bare minimum compliances which each and every company need to follow as part of good corporate governance practice, and it will help them to protect against the consequences of the monetary penalties. Now, the second part, of course, the proper documentation. So as we all know, the corporate tax is a tax on the profit, and profit is the ultimate outcome of a series of commercial transactions, business transactions. So as a thumb rule, each and every leg of the business transaction need to be properly documented, need to be duly authenticated, executed, and properly maintained. So it will help to avoid any kind of conflict, any kind of hassle with the federal tax authorities. For the illustrative purpose, we have listed down few critical areas which need to be given due consideration to avoid any dispute with the federal tax authorities. For example, revenue and expenses. So as we all know, the entire concept of the corporate tax, it revolves around two parameters only, revenue as well as expenses of the company. So it means there is a very strong possibility that any dispute, any clarification with the federal tax authority that may arise on these two parameters only, revenue and expenses. So as a prudent practice, each and every penny of the revenue and expenses that need to be properly recorded, documented, so as to substantiate in case of any clarification is required from the tax authorities. And second one, since the corporate tax is a tax on the income which has been derived, which has been sourced from the mainland transactions. And it is a very usual practice that companies in the free zone and companies in the mainland, they usually enter into business transactions. So now it means, just to avoid any ambiguity, there is a strong need that the transactions between free zone and mainland that need to be properly segregated, that need to be properly documented to avoid any dispute, any ambiguity with the federal tax authorities. Next is employment contract. Employment contract, see again, this is, you can say a very inherent business requirement that companies, parent companies, they usually dispatch their skilled employees to perform certain skill kind of job or services to their overseas subsidiaries. So this kind of arrangement may not be captured by way of having a simple employment contract. Rather, this need to be recorded by way of proper dispatch agreement, secondment agreement, and this need to be drafted keeping in mind the provisions of the UAE Corporate Tax law of permanent establishment. And the proper drafting of such kind of contract, it will help and protect the parent company to come within the purview of UAE Corporate Tax law on the concept of permanent establishment. And third one, intra-group transactions. Intra-group transactions, again, this is a usual business practice that in case of group of companies, they usually enter into business transactions with each other. So under the commercial companies regulations, the intra-group transactions, how it will be entered, how one group company will enter into business transaction with other, it has already been defined. There is a process defined. Apart from the corporate income tax, the concept of transfer pricing, this is governed by the commercial companies regulations as well. So it says that both the contracting companies, both the contracting group companies, the board of directors, in case if the value of transaction is up to 5% of the capital, then the board of directors, in case if the value of transaction exceeds 5% of the capital, then the shareholders of the contracting companies, they need to approve this transaction and declare that this transaction is being entered at arm's length basis. And a brief particular of such intragroup transactions need to be entered in a separate register, and this also need to be intimated to the authority. And the last one, the formation of corporate tax group. Again, it is a very welcome step, and it will give a lot of administrative convenience to the companies, because in case of multiple group companies, instead of filing multiple corporate tax return, one consolidated corporate tax return need to be prepared and filed. Of course, this need to be subject to evaluation of the pros and cons of whether formation of tax group is viable or not. Then for the formation of tax group, you have seen in the previous presentation that there are certain criteria that need to be complied with. And for example, the parent company need to have at least 95% of the share capital, 95% of the voting right, and profit sharing across all the group companies. And all the companies need to follow same fiscal year, and all the companies need to follow the same accounting standard. So to have the uniform 95% of the share capital, voting right, and profit sharing, it can be by way of proper share purchase agreement, proper shareholders agreement, and only then the company can avail the benefit of tax group. So these are the brief areas that I have covered, and of course with the limitation of time. So hope you would have find it informative and useful for your business. And in case if there is any clarification, of course, you can write to us. And thank you very much for giving me patient hearing.
Thank you so much, Mr. Piyush, for your brief. And moving forward to the VAT deliberations under the corporate tax regime, I would like to introduce Mr. Vipin Ahuja. He is the associate partner in for the indirect taxation department in our MBG. So over to you, Mr. Vipin, please.
Thank you, Ali. Thank you very much. And thanks to all of you for joining in. I think in the next few minutes, we are going to discuss about how introduction of corporate tax in UAE can have any impact into VAT compliance. So I believe, first of all, VAT is not a new phenomena for any company in UAE. After the introduction of VAT in 2018, companies has implemented VAT, done VAT registration and filing VAT returns by themselves or with the help of any consultant in UAE. Companies in UAE have seen almost a complete cycle of 5 years where FTA has announced various amendments and issued more than 30 private clarification, public clarification, and some industry specific guides also. However, if you have notices the sequence and the volume of amendments announced by the Federal Tax Authority in last 6 to 8 months, you can clearly notice, or you can clearly conclude, that Federal Tax Authority wants to align their existing infrastructure, their existing teams, their existing laws, which is VAT, excise, and procedural law, with the newly introduced corporate tax law. FTA has announced this corporate tax law, I believe, in beginning of 2022. And right after that, FTA has announced a new tax portal, which was Imara Tax, which has already been gone live from 5th of December. And after this announcement, FTA has changed the VAT decree law, which was decree law number 8, and it has been changed by decree law number 18, where 26 or 27 articles of UAE VAT law has been amended or has been changed. Right after that, FTA has announced a similar kind of amendment into VAT executive regulation. And recently, I think last week, FTA has done some amendments into tax procedural law also. So what I'm trying to say, the main objective of these large amendments in UAE VAT law and UAE tax procedural law was they want to align all the previous laws with the newly introduced corporate tax law. So today, what we are going to discuss, I have covered 8 or 10 topics which can be impacted by the introduction of corporate tax in UAE. So first point is change in ownership of group companies. If because of change in the structure of group of companies, there would be any transfer or conversion of shares or respective payment or contribution between group entities or the shareholders in UAE or abroad, it can impact the eligibility of VAT grouping also. I can take very quick example. Let's say earlier there are 5 or 6 UAE mainland companies has formed a VAT group, but because of introduction of corporate tax and there is any restructuring happening between this group, and it has been decided that any of the LLC company would be converted to sole establishment, then it can have an impact into VAT grouping, because sole establishment cannot form VAT group. And the similar story would be applicable onto when sole establishment will be converted into LLC, because let's say earlier there was a sole establishment which was not the part of VAT group, but now if it has been converted into LLC, it can form a VAT group also. Second point is restructuring for corporate tax grouping. Before deciding on any change into group structuring from city perspective, companies should assess that what will be the impact on VAT, because impact on these changes on the UAE VAT grouping, VAT payable, VAT refundable position, or any easy administration point of view, company has to look upon again. Because let's say today if there is a VAT group and because of city restructuring, if company deciding to break this VAT group, it can have impact. Let's say earlier in VAT group there are 2 companies. One company is into VAT refundable position and another company is into VAT payable position. So it was a set of earlier, but today if it will be a break of VAT group, then one company would be needs to pay VAT to the FTA upfront, but for claiming VAT refund from FTA, it can take several months. Third point is incorporation of new holding company, subsidiary or branches. As we know that to form a tax group into corporate taxation, we need to have a holding subsidiary relationship. And if any group companies, they are deciding to form a new holding or new subsidiary or any of new branches, we need to see that how VAT is going to have an impact, what would be the VAT compliances for this newly formed company, whether this newly formed company can become the part of VAT group or not, what will be the tax position, and how the tax invoices would be raised from that new company. Fourth, most important, liquidation. As from my experience, some companies are doing restructuring. They are deciding to liquidate few companies out of some group. So if any company is deciding to liquidate any existing company, so they have to take this decision keeping in this mind that before going into liquidation, companies has to deregister with Federal Tax Authority. And if they want to deregister, it can take few months, I would say, because before allocating deregistration, maybe FTA would like to go for audit or at least for a limited review. Next slide, please. Yes. So fifth point can be transfer pricing valuation or adjustment. As on today, there is no specific provision of arm's length pricing in UAE VAT law. However, we know that corporate tax law talk about arm's length pricing for the transaction between related parties. So the new valuation or transfer pricing adjustment mechanism could impact the valuation of VAT purposes for the supply between related parties, as well as when any company is going to import from a related party outside UAE. Sixth is irrecoverable VAT. As we know that UAE corporate tax law allows to deduct input VAT incurred on irrecoverable expenses. So earlier, if there was an irrecoverable expenses and we are just putting all the expenses into our costing, but now because corporate tax, after corporate tax, it allows to deduct the expenses for the corporate tax purposes. Therefore, it would be mandatory requirement for businesses to maintain the separate ledger and the records for these irrecoverable input tax, let's say entertainment expenses, motor car expenses, mobile phone expenses, in order to claim for city purposes. Seventh, I think it is also a most important point, statute of limitation clause. This limitation clause came into UAE VAT law last year after the introduction of, specifically when they have announced corporate tax law. After the announcement of corporate tax law, the FTA has amended the VAT decree law, and they have inserted a new article number 79, which says about two things. One is, if any company wants to amend their return, they can do so within the 5 years from the day of filing the return. And the second limitation is, if Federal Tax Authority wants to do an audit of any company, FTA can do audit of any company within 5 years. So how it is going to impact us? FTA knows that corporate tax is coming, and FTA is the only sole authority who is going to see value-added tax as well as corporate tax. So they want to limit both to the assessee and to themselves. The limitation of assessee would be, assessee cannot change their returns after 5 years, and FTA cannot do audit after 5 years. So there would be limitation on both, and that's why we have experienced in last few months, FTA has done a number of tax audit from VAT perspective in UAE. So all the companies should be ready for upcoming FTA audit. Last, reconciliations between custom VAT books of accounts, because we know that there can be various reasons because of which there can be a difference between books of accounts, VAT return, and custom data. I can give you very small example: advance received. Today, if a company is receiving advance from a customer, it is not a revenue if we are following IFRS. But for VAT purposes, we have to pay VAT on advances. So always there can be some transaction due to which there can be a difference between books of account for corporate tax purposes and our VAT returns. So proper reconciliation would be required every time before filing the VAT return. So books of accounts should be either a match with VAT returns and custom records, or there should be a proper reconciliations would be required. Thank you very much. By considering the limited time, this was from a VAT side. If any one of you have any question in relation to that, you can send us the messages to us. Thank you very much. Over to you, Ali.
Thank you so much, Mr. Vipin, for your presentation. Moving forward to the next topic, which is the policies and the procedures and reconciliations, I would like to introduce Mr. Abhijeet Sharma, our partner for the risk and transaction advisory. So, Mr. Abhijeet, over to you.
Thank you so much, Ali, and good afternoon, everyone. It's a pleasure to be speaking at an event where we are talking about an impact of a regulation having an overall bearing on each of the activities of policy, procedures, and reconciliations. So just to set the context, whenever there is a regulation in force, so it is important that the documentation of that, to the extent of a policy or a procedure, and the treatment of it via an accounting reconciliation system is in force and should be monitored over a period of time. True to that spirit, there are three proactive pillars of having a defined accounting policy manual, wherein the relevant aspects of the corporate tax, the alignment of the allowable expenses, the disallowances, how the park and posting control should be working, that should be designed and monitored. To that effect, a step-by-step of a standard operating procedure for each of the steps of the expenses and different line items should be codified. And lastly, the accounting reconciliation system from a statutory reconciliation to a GAAP reconciliation should be done at a regular frequency. All these, this is the basic background of having the robust documentation in place for the corporate tax governance, as we say, and we have been speaking. So this is an important aspect which we advise the organizations to abide. Next slide. So about the accounting policies which we touched based in the first slide, what exactly goes into the details is an important aspect to be understood, where the opening balances of the financial statements of January 24 should be reconciled with the closing balances of 31st December 23. That is very important because ultimately the carry forwards have to be reconciled. having a bearing on each of the line items of the balance sheet, which are being depicted on screen, from the cash and bank to the inventories to the prepaid expenses, revenue, provisions, cost of sales. These are very important items because at the end of the day, to the extent the reconciliation and alignment is in force, the more comfort it would give to a regulator in case there is some kind of a, I would say, an introspection required as to how well the books and accounts are being maintained, whether the policies have been defined, signed off by the people, by the management, and more to that, an external assessment whether has been done or not. At this point of time, it is very important to have an external assessment being done of your system. How well are the policies and procedures and the reconciliations happening to make sure that whenever the call from the regulator comes, you are well aligned and well prepared. True, because as a consulting firm, we help in the risk assessment exercise where we talk about the basic levels of the balance sheet and profit and loss, each of the line items to see where the material threshold and those limits are, and obviously making sure that the entire compliances to the IFRS general principles are met. Next slide. Some of the accounting irregularities which possibly might happen and which needs to be checked, and that is where we come in. You have been preparing your books of accounts as per normal GAAP standards, but having said that, it needs to be aligned to IFRS, which we call the convergence of I to IFRS. So that is where we come in very handy, and this is required because the realignment of the books will be looked into each and every line item. In terms of the controls, whether the bookings have been done on time, whether the depreciation at the correct rates are being there, the contracts with vendors, they are in place. It's not merely a rough document, which is basis on which the transactions are being booked, posted, or being paid, and disclosures are to that effect are being made in books of accounts if in case they are related parties to that effect. So all in all, how it will affect the corporate tax, the impact assessment, the cutoff procedures to the extent they are aligned, it would help in smooth reporting and monitoring of each of the material line items at a regular level, fixed assets and the FAR, as we say, wherever there is a procurement or a disposal being recorded properly. And to that extent, the documented policy, as we call the book closure policy, wherein we perform an entire framework of the controls working effectively or not, that has to be also defined. Lastly, the allowances for the expenses, because the tax gives an element of certain expenses being allowed. To that effect, what are the reporting requisite documentation which have to be maintained? That also has to be considered, followed by the matching principle, of course. Next slide. Out of the three pillars, we talked about the policy, we talked about the procedure. Now the important part is reconciliation. So the framework you have set in terms of the policies and procedures to be abided by within the team, to be independently assessed by someone to make sure that before any kind of a query comes by the regulator, your system is well endowed to handle that. The reconciliation is a third part to the activity, where once based on the background and the guidelines, the transactions have been posted and marked in the system, how to have a reconciliation from a stat to gap being done as part of the closing activity. This is a very important aspect because it gives results to the timing differences as well, permanent and temporary timing differences. So this is something which has to be looked into in detail, obviously making sure that the controls, checks and balances, which was the premise on which the transactions were posted, they are in place. Next slide. An end-to-end coverage of the reconciliation, making sure that the trail of the transactions, the frequency of review, and making sure that the monitoring framework is built for each of the activities. That is a very important aspect to be looked into for the overall reconciliation activity. So as a firm, we help the organizations to make sure that wherever there is a reconciliation activity of the transactions, the checks, controls, they were looked into primarily for the posting of transactions, and subsequently the reconciliations were made in order. That is the overall framework we follow, and we recommend the clients to follow the same. Moving forward. The quality of reconciliation and a robust accounting system. It is important that the general ledger codes which are there, most of the times, what happens is when you have a trial balance, there are certain codes which are opened, but over a period of time, they are unused. So those have to be monitored. The cleansing of the system is very important. That is number one. Reconciliation will give a root cause analysis because some of the expenses you might be having a nature of GL codes having the same kind of, I would say, nomenclature, just to give general expenses or miscellaneous expenses. So you have to also see as to where the exact nature of expense is getting parked properly, posted properly, so that at least you can take the benefit of the corporate tax wherever the allowance for expenses is being given. That is something which you need to do. Against the guard against the fraudulent activity, obviously important because the requisite expenses have to be parked in the material heads. Just to give an example, like miscellaneous expenses and these kind of general expense codes, based on our experience, we have seen them to be misused because certain payments to be made out of the system which should not have gone, wherein the delegation of authority was important. So these is a third part, which is obviously a benefit which comes out of the reconciliation activity. And obviously, lastly, the quality assurance of the financials which are being there and then certified by the statutory audit. With that, I end my presentation. I thank you all for your patient hearing. And I hope that we get any, in case of any queries, we'll be more than happy to answer. Thank you. Over to you, Ali.
Thank you so much, Mr. Abhijeet, for your great presentation. And moving to the last topic for our webinar, the significance of the accounting standards. So I would like to introduce Mr. Taher Singaporewala, the Associate Partner for the Audit and Assurance and the National ICP Certification Department in MBG. So Mr. Taher, over to you.
Thank you, Ali. Very good afternoon to everyone. So last but not the least, we'll just quickly discuss, the importance of accounting standards, the correct accounting practices to be followed by company, and various important aspects related to audits as well. So yes, quickly moving on to the the requirement that has been in existence in relation to preparations of audited financial statements. So a lot of companies in UAE started preparing their financial statements once VAT came into picture. A lot of companies are starting now since corporate tax is there. But just to highlight, this requirement is there since the beginning of company law, which is as back in 1984. So the company law has clearly stated that every joint stock company and every limited liability company in UAE needs to maintain their audited financial statements, and this has been there for the last 40 plus years. But the only thing is, the authorities have been not very strict in relation to the requirements, and they have not been asking for various companies to submit their audited financial statements, which is already a practice as we see with various free zones. So companies in free zones like the Jabal Ali free zone or the DMCC or the Dubai Airport free zone, they generally require audited financial statements to even renew their licenses, which is not a case for the mainland companies, but the requirement has always been there. Moving on to the next slide. So now, as far as the corporate tax is also concerned, they have also put a specific, they have come up with a specific decision where they have put a value to it. So every company that has a turnover exceeding 50 million dirhams will be mandatorily required to also maintain audited financial statements while filing their corporate tax return. So these companies are already having a straight away requirement from the Federal Tax Authority, but as a recommendation from our side, we would not suggest companies only exceeding this turnover to maintain audited financial statements, because when you refer to other laws such as the the Companies Act, it does not specify any limit. So we would suggest every company to maintain audited financial statements in order to have a backup against their corporate tax return filing as well. Moving on to the next slide. Yes, next slide, please. So this is very important aspect just before we close out this session, which is the accounting profit versus taxable profit. So my colleague Janardan spoke about how the computation of the taxable income works. So there is a profit as per your tax calculations, but there will be a profit as per your accounting books. And it is important to understand that there will be a difference between both of them, and we need to maintain a proper reconciliation as well for the same. Now, generally, we understand that there are two types of differences. One is a permanent difference, one is a temporary difference. Permanent differences are expenses which you will record in your books of accounts, but they might not be allowed under your tax computation. For example, like we spoke about entertainment expenses. So only 50% of those expenses are allowed. So the balance 50% becomes a reconciliation item because you will deduct it under your accounting profit, but not under your tax profit. Similarly, various other expenses such as dividend, capital gains, fines and penalties that we pay. So these might be accounted under the accounting books, but these will not be allowed under your taxation calculation. Similarly, there could be various temporary reconciliation items where, accounting wise, you might expense them out in the current year, but from a tax point of view, you will be getting deductions over a period of time, over a period of next 2 to 3 years, such as, the provision for bad debts, various warranty provisions, etc. So that is where companies will have to maintain proper reconciliations between their accounting profits and taxable profits, because this will become an important work paper as a part of your tax returns and as per part of your various supporting documents to provide to the tax authorities in the future as well. Moving on to the next slide. Next slide, please. So here I think both Mr. Janardan and Mr. Piyush mentioned about the applicability of IFRS in UAE. So in UAE the companies needs to maintain their books of accounts as per IFRS, and with the recent amendments that have come into IFRS, so companies will have to ensure that the IFRS compliances are done properly to arrive at the correct profit firstly, because it's not a transactional level tax like the VAT, but it is based on the profit. So if the profit computation is wrong itself, the tax filing goes wrong and there are penalties associated with it. So companies will have to take into account various IFRS, such as IFRS 15, which itself is related to revenue. So the way companies accrue their revenue, a lot of companies in UAE still follow cash-based accounting, where once the money is received from customers, they book it as revenue, etc. So that's a completely wrong way of accounting. So we'll have to follow IFRS 15 in terms of understanding what are the various contracts with customers, etc., when the revenue is due to be recorded, and accordingly it needs to be recognized. So IFRS 15 becomes very important. IAS 16 in terms of property, plant and equipment, because companies will have to see what expenses they capitalize, because wrongly expensing it out will reduce your profit, and which will result in wrong non-payment of tax. Correct. So if there are capitalization of expenses required, it needs to be capitalized properly. Depreciation needs to be charged as per as the rates that are allowed by IFRS. Moving on to the next slide. Yes, in terms of various other important accounting standards like IAS 12 on inventory valuation. So obviously it becomes an important aspect, because the second part of the inventory valuation has an impact on the profit and loss statement as well, which will ultimately affect the net profit of the company. Similarly, various other contingent assets or various other provisions. A lot of companies have a practice of making lump sum provisions for which there are no bases as well, or no calculations which are available with the company. So any such provisions, etc., will have to be done in line with IFRS, and also proper backup and supporting documents will have to be made available, because these expenses for which no supportings, etc., are available can result in non-payment of taxes, which can come up with penalties, etc., as well. So these are some of the important aspects, lastly, which companies will have to keep in mind in terms of maintaining their audited books of accounts, at the same time following properly the international financial reporting standards. I think with that, we will want to end our presentation and open the platform for Q&A session. That's all from my side. Thank you.
Thank you so much, Mr. Taher, for your presentation. So as all of our speakers has finished their presentation today, so we do know that most of you guys you have questions to answer. So let's start with Mr. Omar Farouk. He has raised his hand from the beginning of the webinar. So I will just give him the mic so as he can ask the question he has. Mr. Omar Farouk, please. Hello, Mr. Omar. Okay, so let's go to the questions which we have in Q&A. Mr. Murtaza is asking something about the transfer pricing. So, Mr. Janardan, are you here?
Yes.
Yeah. So, if you can start
Mr.
here.
Murtaza, yeah. So, Mr. Murtaza, actually, all international transactions or domestic transaction with the related party needs to be disclosed in the disclosure form, irrespective of the nature of the transaction. But for documentation, there is a threshold limit, which I have already mentioned, that revenue of 200 million dirham. If there is a revenue of 200 million dirham, then only documentation is mandatory.
Okay.
I hope
Yeah.
it clarifies.
Yeah, I think I hope we have answered all of your inquiries, Mr. Murtaza. So going to the next question, Mr. Janardan, I think it's also for you.
When CT starts to be applicable for company, still did not reach threshold this yet. So to determine this threshold limit, the complete financial year will be considered. So actually in this case, once the tax period will be over, then only you have to compute your tax liability and file the corporate tax return accordingly. So on completion of the financial year, you will be in a position to judge whether you have crossed the threshold limit or.
Okay, so moving to Sabah Hajj question, also Mr. Janardan.
Yeah. What deferred tax impact companies can have as of today for a company who have financial year of January to December. So actually, as my colleague Taher mentioned, that there are two types of differences. One is permanent and one is temporary. So for the temporary differences, deferred tax liability is computed. So deferred tax liability is arised only when the tax, and on the tax there is different profit is calculated, taxable income is calculated, but as per the books of accounts, the profitability is different.
Okay, and Mr.
Is there anything like Companies Act and annual quarterly form filing in UAE? Yeah, Piyush sir, you can.
Yes, that I will prefer to answer. Yes, there is similar provision as per the Companies Act. Here, the Commercial Companies Regulations, it prescribes the filing of annual accounts with the authority. So it is not quarterly form filing, it is annual basis, the financial statement, the director's report, auditor's report that need to be filed. And I think the second question is ESR required for all companies, even they don't generate revenue in the UAE. To answer this question, the ESR, it is applicable on the companies which are undertaking 9 defined activities. So that is called relevant activities. So only those companies which are undertaking 9 relevant activities, they are supposed to file the notification. And in case if they are not generating the revenue, then in that case, they are required to file the notification, but not the report. In the ESR, there are 2 requirements, filing of the notification and filing of the report.
Okay, so the next question, Mr. Janardan, I think it's yours.
Yeah, as the law mentioned, depreciation and amortization rates yet not yet. Not yet. Next question, our parent company is filing tax in Italy, and our financial statement here in UAE is consolidated in the parent company book as foreign branch here in UAE. Do we still need to file CT here in UAE? Yes, so branch offices are considered as a permanent establishment, And as when we have discussed the resident person, so any permanent establishment also requires to get registered in the UAE corporate tax and is liable to tax. So as per the tax treaty between these two countries, UAE and Italy, any type of foreign tax credit can be claimed. But yes, they are required to file return in UAE.
Thank you, Mr. Janardan. So yeah, there's another question is coming. Thanks for
the answer in the previous question. Salary is allowed for owners. Is it applicable for all legal entity type like sole establishment? Yes, so there is a concept of connected person. So wherever any salary is paid, so that needs to be at arm's length, and connected persons provisions are there. So transfer pricing compliances needs to be done.
Okay, thank you, Mr. Janardan. And I think also the next question, it is mandatory to conduct annual general meeting in UAE. It's for you, Mr. Piyush.
Yes, conducting the annual general meeting, it is mandatory for company. In case of mainland, this need to be conducted within 4 months from the close of the fiscal year. And in some free zone, it is within 6 months from the close of the fiscal year. And annual general meeting, the agenda item which can only be decided in the annual general meeting are the approval and adoption of the financial statement and declaration of the dividend, appointment of auditor, and appointment of directors. So these 4 agenda items can only be approved in the annual general meeting. It is mandatory and it need to be conducted once in every year.
Thank you so much, Mr. Piyush. So I hope we have answered all of your questions and inquiries. Thank you so much for your patience and for your time. And please feel free to reach us at any time for any inquiry or any more clarifications needed from our side. And I would like also to thank Dubai Quality Group for their efforts in organizing this productive webinar. And I would like to thank also all the speakers. Thank you, Mrs. Dua, very much.
Thank you, Muhammad. It's actually informative webinar full of information, and that I would like to apologize for our audiences that we exceed the limit, which is 1 hour. But however, we get to know a lot of details we are looking for our companies. To guide you, there is a live stream link for this recording webinar. You can access to our YouTube channels anytime to rewatch this webinar. In the meanwhile, the recording will be published in all the social media channels of Dubai Quality Group. So you will have access also to the recording for this webinar. Thank you so much for attending today. Wishing you a lovely day. Thank you.
Thank you so much, Mr.
Thank you so much. Thank you.
Thank you.
Thank you so much.